What's up to all my investing family out there? It's your man Investing with Cam. It's been a couple of weeks since I've posted anything. Options trading and these posts can be a little repetitive. It's not too much more or anything that I could truly say for the most part, but just want to jump on here and kind of show you guys why I prefer selling options over buying options. And so I'm just going to dive right into it here real quickly. I'm going to choose the August 18th expiration date, which is next Friday. And first I'm going to buy, let's say buy a call. Okay. And so when you're buying a call, you can pretty much, for the most part, choose any strike price. And just to kind of give you an idea, the share price of AMC right now is at $5, okay? And so when you're buying a call, just like it sounds, you're paying in order to open up the options trade. And so I'm just going to say, let's say you choose the $4.50 strike price for buying this call, okay? And so let's say if you do, let's just say you do 2 contracts, all right? And so if you do 2 contracts, your max cost for these 2 contracts is $130, which is not a whole lot when considering if you actually bought, 200 shares of the AMC stock, what that would cost you, in comparison to $130 to buy this particular call. But when you're buying a call, you're basically expecting the price of a stock to go up and keep going up for the most part, and most definitely go above your strike price and beyond, because you're going to have a break-even point, which on this particular option trade, the break-even point would be $5.15. And so in order for you to start receiving any kind of money, the price of AMC in this example will have to go above $5.15. And as you can see here, if it was to keep going up, you would see your profit also go up to where you have an unlimited max profit, when buying any call. But that's kind of gambling in my mind, because like I say, it would have to go above that $5.15 and have to continue to go up. And so that's why I like to stick to selling options. So let me go back, because if this doesn't go above, if AMC doesn't go above the $5.15, you're not going to make any money. And if it stays below that $5 strike, or the $4.50 strike price, or the $5.15, I'm sorry, you're going to actually lose money on your on this particular option trade. So let me just kind of show you if we were to sell. That's why I like to sell options. So I'm going to go here to sell call, and typically when you're selling a call, you want to choose a strike price above the current share price. And so I'm just going to do the $5.50 call. Let's say you paid $4.50 for your shares that you have, because when you're selling a call, you have to have at least 100 shares of that particular stock. And so let's say if you paid $4.50 and you felt comfortable with, $5.50 call strike price, to where you would make that appreciation as well when you're selling that call. But not only that, let's say, like I said, if you got 200 shares, which would be 2 contracts, you would receive, and it's not a whole lot, but you would receive $46 in premium, in opposed to having to pay any money, and so that's why I say selling options to me is a lot more lucrative. It's a lot safer in opposed to buying options, unless you just know that the price of a stock is going to shoot up through the roof when doing calls, and or if it's going to drop when buying puts. I'm sorry. You expect for the price to drop when you're doing puts, as far as when buying them. And when you're selling the put, you don't want your price of the stock to drop below the strike price that you actually choose. But like I said, when selling options, you know, you're going to make premium. You know, it's really truly hard to lose money when selling options, in opposed to when buying options. But I just want to go on here real quickly and just show you guys that. And like I said, you know, to each his own. This is not financial advice whatsoever. I just wanted to show you guys what I personally prefer to do, which, like I say, I prefer to sell options in opposed to buying options, because when you're selling options, you're going to always receive a premium when you're selling options. And I'm going to just do it real quickly. I wasn't going to do it. I'm just going to do the put side of things. And let's just say if you want to buy a put, and like I said, the share price right now is at $5. And let's say if you expect AMC to drop below $5, okay, you would choose the $5 put, in which, you know, let's say if you do 2 contracts, it would cost you $128 to buy those contracts. And as you can see here, AMC would literally have to, and I'm sorry, when buying a put, you expect the price, to go down, but AMC would literally have to go down below $4.36 before you would start seeing any type of profit. And as long as it doesn't, you're not going to make any money. You know, let's show you the reverse as far as selling puts, in opposed to buying a put. So I'm going to hit sell put, and let's just say, you know, you feel comfortable at the $5 strike price again, which is, you know, close to in the money. But when you're closer to in the money, you receive the most premium. But remember, when you're selling puts, you have to have collateral in order to sell a put. And let's just say you have enough collateral to sell 50 puts, in which you would have to have $21,950 in collateral. But if you see here, you would receive $3,050 as long as this put option expired out of the money. Meaning, as long as AMC doesn't drop below the $5 strike price on the expiration date, which in this case is August the 18th, you would keep that whole $3,050. Your collateral, which is that $21,950, would go back into your account, and you could just start the process over again. But I'll let you decide which way to trade options is best. I don't like to do spreads or anything like that, because, you know, you also run a risk of losing money, even though you can make a lot more money with a lot less collateral when you're doing spreads as far as selling options. But I just prefer to play the safe route, you know, and like I said, receive $3,050, which you get regardless, even if the strike price was to, or the current share price was to drop below the $5, you would actually still keep the premium, but you would have to buy, if you see here, the 5,000 shares, in which at that point, with 5,000 shares, you could turn around and sell calls at that point. And so if you got it at $5, you do the $5.50 strike price, and you got, like I said, 5,000 shares, you would get $1,150 in collateral. And then if the price of AMC was to go above that $5.50, and you had, and this contract got exercised, then at that point you would receive the additional 50 cents of appreciation, as well as you would keep that minimum credit of $1,150, and then you can start selling puts again. But I hope this helps a lot of people, gives people an idea of the safest way I feel to make money when options trading. And remember, you know, you just can't jump on Robinhood or a lot of these other brokerage accounts and sell options. You have to go through the settings and get approval in order to sell options. So that means you have to have a little bit of trading experience, you know, have an open account for a while, been trading stocks, things like that. But once you get that approval, you can go ahead and start selling options, and you could basically boost your account up a lot faster in opposed to just holding stocks. But please don't hesitate to like and subscribe to Investing with Cam. Feel free to share my videos. I hope everybody has a great weekend, and thanks for all my new subscribers and as well as my old subscribers, and I'll be back on here with more information. Thank you.